one, but of course the big story this morning is India's current account deficit touching a 9-year high of 4.4% of GDP in the July to September quarter of 2022. This was mainly due to a sharp rise in the merchandise trade deficit in those months. Lata is joining us with her take on this one. Lata?
At $36.4 billion, this is the highest ever, but more importantly, as a percentage of GDP, 4.4% is a 9-year high. The last time we saw it was in 2013, first quarter, Jan-March. This is caused primarily by a huge rise in imports, 30% rise in imports, whereas exports have risen by only 16%. Let's not assume that it is all oil, because non-oil imports also rose by 25%. We have a problem there. Services, now what's done well? These were the things that caused the problem. What's done well? Services exports grew by 30%, largely software, and Indians living abroad and transferring money, that kitty also grew by 30%. So good going over there. Now the current account deficit has to be financed. It gets financed by FDI, a foreign portfolio. FDI also fell. It's $2 billion less than what it was a year ago, 6.4 versus 8.7. External commercial borrowing loans taken by Indian corporates also finances, that was nil in this quarter. And that is understandable because there is global tightness and the euro-dollar market is hardly working. So as a result, we have a balance of payments deficit of 30.4 billion. Last year, same quarter, it was a balance of payments surplus. This year, it's a deficit. We rarely have these deficits. Now, let me also give you the good news. The good news is on the previous quarter. April, May, June quarter, we were originally told that the deficit is 2.8% of GDP. Actually, the current account deficit has been revised lower to 2.2%. And that's because the April-June imports have been revised a good 6 billion lower to 185 billion from earlier 191 billion. So the earlier trade deficit was, for the 3 months, was 68 billion. It's now actually 63 billion. So the first half CAD now that we have Q1 and Q2 works out to 3.3% of the GDP. This is still bad. You know, anything over 2.5% to 3% we consider a worrisome. So it is a 9-year high. However, economists tell me that they expect the second half CAD to come down a bit, but 3% and above, it's likely to be, they say.
All right, so that's the big number that we are looking at. Lata, thank you so much for making sense of this current account deficit number that we got. With that, we'll slip into a short break. Up next, we'll get you all the cues from the commodities market. Stay tuned.